Hi, and welcome to this new episode of Finance Rundown. In this episode, we are going to be talking about a couple different concepts, but mainly we are going to be touching on what is financial literacy, what is the benefits, what is the strategy of how do you become financial literacy literate, and also what's the strategies. And I'm going to give some examples of how you become financial literate and what is the benefit of becoming financial literacy in your personal growth and being most importantly, why is it so important to you, and why is it also so important for your financial freedom? Not necessarily when it's getting a credit card, but also what should you do to save up. So basically, I'm going to give you a rough definition of financial literacy. So financial literacy is the ability to understand and effectively use various financial skills, including personal financial management, budgeting, and investing. So why I mentioned those three: personal financial management, budgeting, and investing. So personal financial management is basically when you're gonna put in that is personal finances is a term that covers managing your money as well as saving and investing. So what is personal finance? It's basically it compresses budgeting, banking, insurance, mortgages, investments, and retirement, tax, and estate planning. So why is personal finance so important to people? Is because with a personal finance goal is an individual goal that you desire for, you want to use to save up to go on a vacation, or if you want to save up to go and get new things. So what a lot of people do have a personal goal is they want to save up for a home. For a lot of people who are in like the 30s or in their 25s and up, are trying to save for a home right now so they can put down payments on their home so they can be financially free, have financial freedom, that they don't have to keep paying rent that has skyrocketed to the point of it's so outrageous now where people can't afford to live in apartments in a good locations and not have anything wrong with the apartment. But then also a lot of apartments have also been getting on board with this because they know that they are they have a target audience that they can get, especially for apartments that are close to universities, where sometimes the apartments are not a great quality or not a great fit. So as a personal education or personal areas of personal finance that people need to keep meeting is like, if you have someone that you can talk to at the bank, have a monthly or yearly meeting with someone that they can go over your goals. If you say you want to retire at 72, you make sure you can meet that benchmark of retirement and make sure you have enough money in your accounts that you can retire at that age. And then also make sure you have your personal finances of having auto loans, your credit card balances, and your consumer loans is basically your how much you're paying for certain loans. And so your credit cards is like your monthly payment. It's kind of like having a lot of people told me, credit cards, a wise person told me, is credit cards are kind of like having a mini mortgage. even though they're not a mini mortgage, but it's considered because you're paying interest on that and to lower it down. And it's the kind of the same thing if you have student loans. You're trying to pay that off over time so you can live a comfortable life. So there are 5 areas of personal finance that are income, savings, spending, investing, and protection. So the first one, income. So is how much money you're bringing in after your taxes are deducted. So that's what your income is basically your after all the taxes is your net income. Your spending is how much you're spending on a typical day of what your bulk income goes to. So it's spending for like what you're going to buy things, like your rent, mortgages, groceries, hobbies, eating at restaurants, like buying new home furnishing, home repairs, travel, and entertainment. So basically these are like considered the spending, because even though like home repair and travel can kind of go both into spending and savings, because home repair is basically, that's a necessity. Because especially sometimes when, say, if you live in the south, you are in Tornado Alley. So basically Tornado Alley is parts of like the central part of the US that go from like Texas all the way up, where they're in like tornado season, or when they get severe hail storms, and that's like all the damages. But sometimes if you have to put that to a side and contact your homeowners association or homeowner your insurance that protects your homes, so you can do that. Sometimes they will cover some of the costs, but then also a lot of your things might go up. Your premium payments might go up because of severe weather. And then your savings. So your savings is basically, if you have a savings account, is basically your income that is left over after spending. So what you kind of typically want to do is you want to keep enough in the savings account for what they say is rainy day expenses. So basically rainy day expenses are anything that is, if you say you get laid off, or if you are trying to save up for a down payment on a home, then you can use that as savings. But also typically you want to have savings that is between 3 and 12 months of expenses. So if anything does happen to you, you can use those savings to increase your income into your account, so you're not having to flush with cash. But also you have to keep in mind, you have to use that sparingly when you are trying to look for jobs, or if you're on, like for me, what happened was I was on medical leave. I'm not going into full detail, but I had enough savings left over to pay off a couple of medical bills, because I was trying to pay those down so I didn't have as much to pay on. And so what is another key one for personal finance is investing. So for people with personal finances, it's the goals to have understand for, it's when you're purchasing assets, it's usually stocks and bonds that are being returned on money invested. So basically investing is the aim to increase individuals' wealth beyond the amount they invested. So also what you have to keep in mind is investing does come with a risk. So because not all assets appreciate, and they also can occur a loss. So because basically investing is very difficult for those who are very unfamiliar with it, and it helps to dedicate some time to gain the understanding through reading and studying. If you don't have time, well, you can hire someone, a professional that can help you invest your money in this. So what can you can get from like personal finance services? You can get wealth management, loans and debits, budgeting, retirement, tax, risk management, estate planning, investments, insurance, credit cards, and home and mortgages. So what you have to know is like know your income. So is like how much you are gonna bring after taxes and withholdings are taken out, and devise a budget. As you have to keep in mind, a lot of people say the 50-30-20 budgeting method offers a great framework, but also a lot of people, you can play with that because a lot of people some people use 70-20-30, where depending on how much you make compared to how much you put into savings. So say if someone brings home $15,000 a month after taxes, so you have to, so that the 50-30-20 will be a great fit for that person, because you can even that out a lot easier. And so for a person who works hourly, that's going to be a little bit harder. So a lot of people, I like the 70 rule, because it's a lot easier for me to track my income, especially when just graduated from college, and it's pretty easier for me. So I kind of went into the a little bit in the details right there. So, and then also the financial literacy also comes into what is very common. So financial, that people have to understand that the financial industry regulatory authority that attributing is to 66% of Americans. So because this is an interesting thing, that being financial literate can lead to a number of pitfalls, such as being more likely to accumulate unsustainable debt burdens, and either through poor spending decisions, a lack of long-term preparation. This in turn can lead to poor credit, bankruptcy, housing foreclosure, and or negative consequences. So basically, poor credit is basically if you have credit that is, maybe some places say poor credit is below like, I don't know, like under 500 or like under 600, somewhere that range. And so bankruptcy is, you go through the bankruptcy proceedings and you are trying to consolidate your loans so you can make the one easy payment. So bankruptcy is a legal proceeding entitled when a person or business is unable to repay outstanding debts or obligations. So basically, outstanding debts is your money that you have, like loans that you are trying to pay off, or obligations. Say you're a business and you like just recently Bed Bath & Beyond went on bankruptcy and foreclosure, so they have to pay their debt to the people who they owe the debt to. Then the second is paying the dividends and shares to the preferred stock. And then after the preferred stock, it would be the regular stockholders. So that's just for a business, but for personal bankruptcy is a little bit different, because there's a couple of different bankruptcy that people can go to, but I'm going to give a little bit background on bankruptcy. So this is how bankruptcy kind of works, is so it's basically it's a starting of clean slate, is forgiving debt that they can't pay, and it's meanwhile it's creditors that have a chance to get some repayments based on the individual or business assets available for liquidation. So liquidation is basically when they're liquidating all the person's assets into one thing, like a house is considered an asset. Even a car is considered an asset. Even certain things in the homes is considered assets. So then also after they liquidate all of that, and so once the creditors get all of their share of how much they owe, how much that person owes, then basically all bankruptcy cases have to go through federal courts in the United States. And then a bankruptcy judge has to make a decision whether a debtor is eligible to file and whether they should be discharged from their debts. And then this also gets interesting when it's like trustees, and also it's like trustees or estates that are going through the proceedings. And so what are the types of bankruptcy that people file? So for individuals, so which chapter of the bankruptcy code that people can file for? Chapter 7, that involves liquidation of assets. Chapter 11 deals with company or individual reorganization, and Chapter 13 arranges for debt repayment with lower debt convenient or specific payment plans. So a lot of people try to use Chapter 7 a lot more, or Chapter 13, which is a little bit more. Chapter 13 is a little bit more popular if your debt is like manageable, where you can still pay off the debt, compared to Chapter 7, where you're trying to liquidate your assets and try to pay off the creditors, because it's a lot easier to do. So basically, I kind of mentioned like Chapter 11, Chapter 7, Chapter 11, and Chapter 13. So I'm going to go into Chapter 7, bankruptcy, a little bit more detail. So Chapter 7 allows you to dispose of unsecured debts, such as credit card balances and medical bills. So a lot of people that go into Chapter 7 have a ton of medical bills that they cannot pay because of how much medical debt they've gotten into, because of, say, if people keep going in and out of surgeries, or if they have to go and ride in an ambulance. That's really costly, and insurances will not pay for that. And so what would be the other option? So basically what Chapter 7 goes into is like you're gonna liquidate all your assets. So it has to be like what you are collecting, like your high valuables, and also what you're collecting, your second home if you have a second property, your investment portfolio, like if you have stocks or bonds. And so basically what the Chapter 7 does is basically selling off of your assets to clear all the debt. So then after Chapter 7 bankruptcy, you're pretty much debt free. And that's sometimes what a lot of people do, because it's slightly easier, especially if you have a second home or a second property, that you can do that. Chapter 11 is a little bit tricky, and I'm gonna say it's used for a lot of individuals, but it's also used for organizations. So I'm just going to give you a little bit cliff note on Chapter 11. So basically what Chapter 11 bankruptcy is it's a big goal for using that to reorganization of a business, and it's trying to keep the business in business so they can keep going through and try to pay off the debt. So basically, I'm going to give you a little bit of a cliff note here. So Chapter 11, Bankruptcy, allows a company the opportunity to create a plan for profitability, cut costs, and find new ways to increase revenue. And so the preferred stockholders, if they have any, have to receive payments through common shareholders will be the last in line. So as basically what happens with Bed Bath & Beyond, they believe they filed for Chapter 13 bankruptcy. So basically, Chapter 13 is they have too much money to qualify for Chapter 7 bankruptcy may file under Chapter 13. And so, known as Wage Earners Plan, it also allows individuals as well as business to consent income to create workable debt repayment plans. And so also, the repayment plans are coming in installments over the course of a 3 to 5 year period. And then they're repaying the creditors. The court allows these debtors to keep all their property, including otherwise non-exempt property. So basically, there's either, while Chapter 7, Chapter 11, and Chapter 13 are the most common bankruptcy proceedings, there are several other types. There's Chapter 9, Chapter 10, Chapter 12, and Chapter 13. So I'm not going to go into all those details of Chapter 9, Chapter 10, Chapter 12, and Chapter 15 bankruptcies, but I will go and talk to those into a deeper detail in my next episode. So basically, I kind of went into why you should be very careful and be a financial freedom, and I talked the high places to go if you don't be financial freedom. You have more likely to go into debt. You're more likely to go into bankruptcy, and also what most people don't realize is when you turn a certain age, some companies, it might be 18 or 21, and so what a lot of people don't understand is you should put yourself in a 401k plan. This is why. When you turn a certain age, you can keep incurring that retirement plan, and you can keep that or reopen another one with different companies, or you can roll into the company you are working at the time. So there's a couple of different kinds of investing accounts. There's the individual retirement account, or everyone knows it, IRAs, and the other one is tax advantage retirement accounts. So I'm going to go into a little bit of detail of individual retirement accounts, or IRAs. So the IRAs, or as I just stated, individual retirement accounts, is a tax advantage retirement saving account to which you contribute either pre or after tax money, and which goes on after a tax deferred or tax free basis. So it's basically what is an IRA? So an IRA is basically a long-term savings account that you or me with earned income can use to save for a future while enjoying certain tax advantages. So why is tax advantages so good? So the money you put in, so how does an IRA work? You guys are wondering about that. So with anyone with an earned income can open and contribute to an IRA, including those who have a 401k account through an employer that you work at. The only limitation is to the total that you can contribute to your retirement account in a single year. When you open one up, arrange a financial product including stocks, bonds, exchange trade funds, ETFs, and mutual funds. And so basically with an IRA, you can use with an IRA, you can be a little bit like, if you want to be aggressive, but also you want to be on the safe side, you can also do that. I like to be on the aggressive side with my IRA. That's me. And the tax advantage retirement accounts, I'm not going to go into a little bit of detail because sometimes that's not really an option, or that's not really as an popular as individual retirement accounts or 401ks. And so when you're having when you have after you retire and you're putting money into your account, so what's the social security benefit to that? So basically, when you're having savings and investings, and once you have a choice between, I know right now is becoming more popular is credit unions, because credit unions are, you put money down, some require $5, or and then also some other credit unions you have to be in teaching to be in a credit union, or form of military service, or if you're a firefighter or a police officer or a state trooper, you are qualified for certain different credit unions. Or if you say you graduated from one university, they have a credit union that you can go to and open up an account because you're an alum of that said university. So what's the basics? So if you want to set up your own home, and what most people don't teach you that sometimes you have to learn on your own, is what does it encompass? It's basically banking, budgeting, handling debt and credit, and investing. So what you have to take to these basics is when you're opening a banking account, is basically 6% of households in the United States do not have a bank account. Why it is so important to have a bank account is because it's safer than holding cash. And it's the asset held in a bank are harder to steal in the US. Your bank account is Federal Deposit Insured Corporation, FDIC. So basically, you're insured up to a set amount of your checking and your savings account in that bank. So say if the bank goes under, you can use that to help you. So why many financial transactions require you to have a bank account is to use debit or credit cards, is to use apps like Venmo or PayPal, or I think what's the other one is Cash Card or something like that. Also write a check, which I know a lot of us Gen Zs or millennials do not know how to do, unless if you have parents that have taught you how to write a check. Use an ATM that is associated with your bank, because if you use a non-bank associated ATM, then you have service fees. And then buy or rent a home. And if you have a bank account, you can receive your paycheck from your employer. That's called direct deposit. And also, if you have a savings account, you can earn interest on your money. So what's the difference between online and brick and mortar banks? So basically, a lot of banks have been slashing their spending or their presence in certain areas because it's a lot of banks are trying to go more on online banking because it's more cost effective than having true store locations for people to go that can go to. And so I like, honestly, for me, having online can be great because you can actually get access to your checking and your routing information a lot easier than instead of going to a physical bank location. But if you have an issue, if you have your debit card stolen, or if you have fraud on your account, you have to call a certain number and they will suspend your account. But then also keep in mind, if you don't have a physical bank location, it's going to be really hard for you to get your money. And so what a lot of people do is, because they're so fed up, they switch to a credit union, or they switch to a different bank because it's closer and it's considered convenience. A lot of people pick certain banks because it's convenient for them, or it's easier because they know people, or they greet you at the door and be like, "Hi, please, thank you for being here." And so I'm going to go into different details, like there's difference between retail banks, credit unions. So retail banks are for-profit companies that offer checking and savings accounts, loan, credit cards, and insurance. Retail banks have physical in-person buildings that you can visit, or they can be online only. So most of these retail banks offer both options, and they also have more location ATMs nationwide than credit unions do. So basically, a credit union is they have multiple different small branches, but it's a non-for-profit organization which is owned by their members. So credit unions tend to have lower fees and have better interest rates on savings accounts and loans. So a credit union are sometimes known for providing more personalized customer service, though they usually have far fewer branches and ATMs. So a credit union I'm going to go into more detail about credit union. So basically, a credit union they have fewer locations, but they have, what I like to say is, they are better at understanding customers, and they will greet you by your last name, and you can go in and be like, "Hi, I want to open up an account," and then you have to be a member. So the only drawback with a credit union is, before you can open up an account, you have to be a member. That is, a credit union is like a common bond, who shares a common bond, working in the same industry or the same company, or living in the same community. So basically, as I said earlier, a credit union, you have to be in either the same industry or have the same common purpose. Or what a lot of credit unions do is, if you say you have a family member who is in that credit union, or you have a friend and they share their membership code, or their a referral code to that credit union, you can get in that way. That's what most people do. And some credit unions are kind of picky who they will take. So advantages, what I like about credit unions is, credit unions are exempt from paying corporate income tax on earnings. And also, the second thing is, credit unions generate only enough earnings to fund daily operations. And so basically, they enjoy narrower operating margins than banks. And so basically, because the reason why credit unions, they don't need to make their shareholders happy to that they don't have to increase their earnings every quarter compared to a traditional bank. So I want to say thank you for taking this time out to listen to my updated episode today. And you guys have a wonderful Memorial Day that is coming up on Monday. See you guys. Have a great rest of your holiday weekend. Thank you. Bye.